And can everybody please make sure that their cell phones are muted or whatever it is that you do with them. Thanks.
Good morning. Governor Poloz and I are pleased to be here to talk about today's interest rate announcement and our monetary policy report. Before we turn to your questions, let me just take a couple of minutes to give you an idea of the most important issues that came up during Governing Council's discussions. We started by noting some very positive developments. The Canadian economy continues to operate near its capacity, and growth is relatively broad-based across sectors and regions. Meanwhile, inflation is close to our target. So what stands out is that even with today's increase in the policy rate to 1.75%, monetary policy remains stimulative. In fact, the policy rate today is still negative in real terms. That is, once you adjust for inflation. Given this context, it's natural that our discussion centered on the main factors driving economic activity and inflation over our projection horizon and the appropriate pace for returning the policy rate to a neutral stance. Now, let me remind you that our estimate of neutral is in a range, currently 2.5% to 3.5%. It's a range rather than a point estimate because the neutral rate is unobservable and it can change over time. So let me talk about our assessment of inflation developments. Inflation was running near the upper end of our 1% to 3% target range in July and August, a little higher than we had expected in our July monetary policy report. And as we said in our last interest rate announcement in September, the staff assessment was that most of this surprise came from one component of the Consumer Price Index, that's airfares. They judged that this component would be volatile over coming months because of methodological changes that Statistics Canada put in place. Well, the staff were right. The most recent data released just last Friday show that inflation fell back to 2.2% in September, due in large part to a reversal in the airfare component. We could see further volatility from this component in coming months. Ce qu'il faut souligner, c'est que nos mesures d'inflation fondamentales restent fermement autour de 2%. Ce résultat cadre avec une économie qui tourne à pleine capacité. Cet épisode illustre toute l'importance de faire la distinction entre les éléments volatiles de l'inflation et les pressions sous-jacentes plus persistantes. Jusqu'ici, les marchés de travail montrent peu de signes de pression sur les salaires. Malgré un taux de chômage proche de son plus bas niveau en 40 ans, la croissance sous-jacente des salaires avoisine à 2,3%. Il s'agit d'un indicateur rétrospectif et nous prévoyons que la croissance des salaires augmentera durant l'année à venir. Les entreprises avec qui nous avons parlé dans le contexte de notre enquête de l'automne sur les perspectives des entreprises s'attendent à ce que les hausses salariales accentuent au cours des prochains trimestres. Et nous ont aussi dit que les pressions sur la capacité de production demeurent élevées et que les pénuries de main-d'œuvre deviennent plus intenses. Governing Council spent a considerable amount of time discussing the implications of the U.S.-Mexico-Canada trade agreement. The USMCA is good news because it will reduce an important source of uncertainty that had been holding back business investment. Remember that we've been marking down our investment outlook because of this uncertainty. We know from our latest business outlook survey, which was completed before the agreement was reached, that business investment plans were already quite positive. Firms told us that they were looking to increase capacity and productivity to take advantage of strong U.S. economy. And so, given the agreement, we've reversed some of the markdown of investment. To be prudent, we didn't remove all of it because we want to see how firms actually adjust their investment plans. This prudence is also because we know that competitiveness challenges continue to weigh on investment. The approval of the LNG project on the West Coast adds to the good economic news, although its impact is somewhat offset by lower commodity prices. Overall, the projected investment profile is higher than it was in July, increasing both actual growth and the economy's potential to expand in a non-inflationary way. Cela dit, les mesures protectionnistes, notamment celles concernant les États-Unis et la Chine, ont aussi retenu notre attention, car elles pèsent encore sur les perspectives mondiales. Nous avons intégré dans nos prévisions les incidences attendues des droits de douane imposés jusqu'à maintenant, et nous avons aussi intégré un effet modérateur sur la confiance qui proviennent de la menace de nouvelles mesures. Tout compte fait, nous estimons que ces facteurs devraient réduire la production mondiale de 0,3% d'ici la fin de 2020. C'est un coût considérable, ce qui élève de plus de 2 milliards de dollars américains. Cette situation représente un risque aussi bien à la hausse qu'à la baisse pour la politique monétaire canadienne. En effet, il est possible que les États-Unis et la Chine réussissent à apaiser ou à régler ce conflit commercial. Un tel résultat serait positif pour le commerce international et les investissements et pour le Canada. Le conflit pourrait toujours s'aggraver, ce qui mettrait en péril d'importantes chaînes de valeur mondiales. Bien sûr, cela diminuerait la croissance à long terme et la prospérité à l'échelle mondiale. Toutefois, les conséquences globales pour l'inflation seraient incertaines. Closer to home, Governing Council has been assessing how people are adapting to both higher interest rates and the changes to mortgage underwriting guidelines implemented earlier this year. We've seen that households are adjusting their budgets largely as expected. We understand that this can be difficult, particularly for those who are highly indebted. At the same time, employment and incomes continue to grow, which can help to cushion the adjustment process. Further, the quality of new debt is improving, and housing activity is moderating to a more sustainable level. All of this is making the economy more resilient and reduces the chances of painful outcomes for many people further down the road. The rule changes also appear to have helped take the wind out of the sails of speculators in some markets, which reduces the pressure on housing affordability. Overall, while financial system vulnerabilities are still elevated, the fact that they have stabilized and edged down in a number of respects is positive. There's an updated analysis of these household issues in Box 4 of the Monetary Policy Report, and a more detailed staff analytical note will be published about the effects of the underwriting guidelines on borrowing on the Financial System Hub that will be launched in a couple of weeks. The hub is designed to be a place on our website where we can post our analysis of current financial system vulnerabilities and risks in a manner that is accessible to a wide audience. Given all these factors, Governing Council agrees that the policy interest rate will need to rise to a neutral stance in order to achieve the inflation target. You may have noticed that we haven't used the word gradual to describe the pace of monetary policy adjustments. This is to avoid the impression that we are following a preordained or mechanical policy path. The appropriate pace for interest rate increases will depend on Governing Council's assessment at each fixed announcement date of how the outlook for inflation and related risks are evolving. In particular, Governing Council will continue to take into account how the economy is adjusting to higher interest rates, given the elevated level of household debt. While the focus of many commentators tends to be on the downside risks, it's also possible that strong consumer confidence builds on solid job and income growth and leads to greater than expected consumption. We will also pay close attention to global trade policy developments and their implications for the inflation outlook. Again, we need to bear in mind that this risk is two-sided. And with that, Governor Poloz and I would be happy to take your questions.
All right, I already have a list here, so if I haven't pointed at you or whatever, then, and you want to be on the list, now's the time to make your move. We'll start, and I'm going to apologize for butchering your name again. Roel Vandenet from Epoch Times.
Yes, hi, good morning. Just regarding the threat to global growth and the Canadian economy coming from China dealing with the trade war with the U.S., seeing the big decline in their stock market and currency. Do you see this, I know you mentioned the two-sided aspect of it, but do you see this in terms of like the potential for something much worse, given that the Trump administration and the allies are trying to, put pressure on China to clean up their act in international trade, and so but do you see that as being the downside case for the Chinese economy if it tries to react to that and what it can do?
I'll take that.
Sure.
Well, this fact is that trade actions, such as the ones we've already seen, are well known in the economics literature and from history to slow economic growth, not just in the countries that are affected, but globally, especially given how integrated economies have become. This is the principal reason why the IMF downgraded its outlook, and it's why we've downgraded our global outlook. And it's to take account of the actions that have already taken place. The threats of even more extreme actions, of course, makes that risk a larger risk. The way this normally works would be that on both sides there's an escalation of those tariffs, and that will, of course, raise prices for everybody, and it slows economic growth. And it will slow growth in the two principal engines of the global economy. And that, of course, then has spillovers for everybody else. And so for here in Canada, the main thing what we see already is lower commodity prices, which is a shift downwards in Canada's terms of trade. But as time goes on, it would be more like a slowdown in our export growth because our principal trading partners were slowing. We see the market turmoil, if we call it that, as you referred to it, but corrections in the stock markets as a symptom of this underlying cause, but also, a more basic issue, which is that the global economy is normalizing, and monetary policy is moving to a more neutral stance in many places. And as that happens, the relative pricing between stocks and bonds generally will adjust, and that's often a volatile kind of process. And so volatility measures have gone up. And I think that's the more likely cause of what we've been seeing, but these markets are far forward-looking. And so, of course, they're watching very closely the developments in that trade conflict. So we highlight it as our primary risk to the global outlook, and therefore for Canada. But what we have to do is acknowledge, as Ms. Wilkins just said in her opening remarks, that these are two-sided risks, because it's entirely possible to see a negotiated de-escalation in short order, which would convert that into more lift for the U.S. economy and the Chinese economy and for everybody else at the same time. So if we were traders in the financial markets, we would be free to choose one of those narratives and say, that's my narrative and I'm going to position around it. But as a central banker, we cannot. We need to take account of both of those range of possibilities and, in effect, choose some middle ground, which hedges both of those risks appropriately. That's exactly what we mean by risk management.
I mean, do you see, in terms of the levers that the Chinese authorities can pull to reduce the impact of the trade war? It seems China's taking it, worse than the U.S. Are there concerns that you have about them, like exacerbating financial vulnerabilities and the debt, and that longer term having bigger impacts for Canada? I mean, maybe it's a bit of a longer term issue, but it seems very tricky with the situation China faces if they do more accommodation.
So
So China is, and before the trade conflicts started to escalate, was already looking at its high level of leverage and financial stability issues, and also the fact that potential output growth was slowing, and pivoting towards an economy with lower leverage and less reliance on investment and more on domestic consumption. And of course, they had started off the year with taking some very decisive actions to bring leverage down, and you can see that those actions have worked. Now with the trade conflict, it's making that balancing act a little bit more difficult. They do have levers. They just most recently changed the reserve requirements. They have some fiscal space. They have other space on the monetary policy side, and so it's up to them to strike that proper balance. And our base case with growth in the Chinese economy of around 6% is that they will be able to do that. I think the risk is the one that you identified. If there's further escalation, it just makes that balancing act more and more difficult.
Kevin Carmichael, the Financial Post.
Judging by your statement, you probably anticipated a certain reaction in financial markets to the absence of gradual in the statement, which has been being interpreted as hawkish and suggesting that the central bank's pace, at least, of raising interest rates has sped up. Could you address that as clearly as you can? Has anything changed today, or is anything different today than a couple of months ago? Is the pace to a neutral rate faster today than it was 2 months ago, I guess is the question.
You know, what we were seeing is that there was quite a focus on a single word, gradual, to kind of encapsulate all the things that Governing Council considers when deciding what's the appropriate level for the overnight rate. And we felt that it was the right time to be clearer, in fact, about what was on our minds. And we were clear in a couple of ways in terms of talking about moving to a neutral range, a neutral stance for monetary policy. So that tells markets and households a little bit about the destination, which I think is quite clear. And then with respect to the pace, we're also clear about what's on our mind. And I won't repeat what I said in the statement. So what it does mean is that every decision is a decision. And yes, it's possible that the pace could be a bit faster, but it's also possible that it could be a bit slower because, as I said, the risks are two-sided and will be decidedly data-dependent. And we're hoping that participants in the markets and households will be doing the same thing.
Follow-up to that, are the headwinds facing the Canadian economy today weaker than they were a couple of months ago?
Certainly the headwind that was coming from the uncertainty with respect to trade policy, the NAFTA, has come down. As we've mentioned in the monetary policy report and in the statement, it's prudent to watch the data, so we've taken off some of our downward adjustments to the inflation forecast relative to what our model would say, because we anticipate that businesses will become more confident, but we want to be prudent in terms of the timing of that and actually see the data. In terms of the other headwinds, so you can see that households are adjusting. We were wondering about how the housing sector would adjust to the B20 changes as well as other municipal and provincial measures in particular markets. And the analysis that we see, you always need to see more data because it's still relatively early days, but they seem to be adjusting as we had expected. Housing markets seem to be stabilizing and at a lower level and probably a more sustainable level, and we're carrying that through the projection as well. So those are some of the changes. Yes, there are risks to the outlook. You want to call those headwinds. They're on both sides, coming from the trade and other things as we've listed in the report.
Greg Quinn, Bloomberg.
I wondered why you mentioned interest rates need to rise just to neutral. Are you trying to signal that there's kind of a cap on how far you're going to go here?
Well, I wouldn't describe it as a cap, but it's an expectation based on our projection that, in effect, the economy has converged on its potential level at a potential growth rate with inflation on target. So basically what we're talking about is the last element of that normalization process, getting home, as we've described it. And, until some new shock throws us off of that trajectory, we wouldn't be expecting to be going into a contractionary stance for policy. But what we do know today is that we are still being quite stimulative at a time when the economy really does not seem to need it, except for, as was just mentioned, perhaps there are some lingering adjustment processes ongoing. So that's what makes it a process of data dependence, so that we're making sure that we're taking full account of all those adjustments as we go forward, and not being mechanical about a return to neutral.
I wonder why you're reluctant to say that we're at full output, that we're close to it. Unemployment is the lowest in decades. Inflation went up to 3%. The big risk of NAFTA being replaced is gone. Why are you still of the view that we're sort of being held back here in the economy?
Well, by our estimates, we say near potential or near capacity. It could as easily be above as below. We are in a zone which we define as, rather a statistical zone, if you like, of where potential is, where capacity is. It's not an observable variable. So those estimates suggest that we're in the zone of plus or minus 1% of capacity, and so in that situation, you're just as likely to have a positive shock give rise to a forward-looking inflation risk as a negative shock give you a risk of lower inflation in the future. So we call that near capacity. That doesn't mean almost at capacity. It means in the zone where it could just as easily be zero excess capacity. We look at, that's from the production space. So if we look at the labor market, sure, there are still features of the labor market that suggest there may be pockets of capacity. But I think our most important remaining area of expansion is through productivity. We're at the stage of the business cycle where normally investment would have been stronger were it not for the uncertainty around the future of NAFTA. And that would have been building a little more capacity into the economy and allowing exports to grow faster into the bargain. And so we would still be watching for that phenomenon to take place. And that would include labor market churn as people find the right role for them using all of their skills, and so you get a higher productivity lift from that, and probably the increased reentry into the labor force from the bottom, especially in the youth category. So those are kind of the remaining dynamics that we're watching closely. Those stories haven't gone away. It's just that there's not much new to tell about them at this stage. When we get the next set of national accounts, we'd be looking at the investment numbers closely to see how we're doing with that. And the next set of revisions will be next spring. That gives us more of historical context for those big questions.
Kim McCraw, Wall Street Journal.
Thanks. In the statement, you talked about the Bank of Canada looking at household vulnerabilities as it considers the pace of future rate increases. Can you be a little more specific about what you're looking for in that, and what kind of deterioration in household vulnerabilities would cause the bank to give some pause to the pace of rate increases?
So what we look at when we see how they're adjusting is on two plans. One is just how we think the mortgage costs for people who have mortgages are going to adjust. And you will recall in our July monetary policy report, we were quite granular in showing that, giving examples of people who originated their mortgage in 2014 or 2015 and what kind of rate increase they might be facing, and how that would affect their debt to service ratio, which is in real time something that people are concerned about in terms of how they need to adjust their budgets. And we continue to do that. And what we find is pretty much the same in that the increases that they've seen so far, especially for people, and this is a bulk of the people with the mortgages that are not highly indebted, those increases in the debt-to-service ratio are either very small or to the extent that they're quite manageable relative to their incomes. Where we see that it's more difficult is for those who are highly indebted, so those who are have loan-to-income ratios greater than 450%. So we pay pretty close attention to that, and we've tried to put a lot of that into our economic model. And so that higher sensitivity is already in our forecast, and the interest rate path that we would look at as part of a forecast would take that into account. But a model is just a model, and so we need to see the data in real time and see how consumption is evolving, as well as how housing markets are evolving. And as you know, housing starts and other measures of activity fell off quite a lot at the beginning of the year and through the summer. We see that stabilizing, and also in price space. And so we think that it's kind of hit a level that is stabilizing in many of the markets. And of course, the biggest changes were in the markets that had the most adjustment to make. So the Greater Toronto area and the Vancouver area. Everywhere else was already a little bit more stable. And so we'll keep an eye on these things. I think higher interest rates are always difficult when people haven't seen them for a long time. But when they're coming at a time when the economy is growing, and it's a sign that we're getting back to a more normal phase, in a lot of senses, it's good news.
And just with respect to the term gradual that you discussed a little bit already, I understand what you said, that it allows the banks some flexibility to go at either a faster or a slower pace than you might otherwise. It's being fairly widely interpreted as allowing the bank to go at a faster pace, more specifically. Would you dispute that interpretation, or would you say that it's truly a neutral up or down decision?
What you say is exactly right, that it does permit the flexibility to move at a faster pace. But that would be completely hypothetical depending on the data. And so it also permits us to go at a slower pace if the data suggests, for example, that the household sector is having difficulty digesting a higher rate of interest. If the adjustments prove more abrupt than our model suggested, et cetera, then that would give us a reason to pause and assess longer. You start stacking up positive risks like, negotiated settlement to trade actions between the U.S. and China, and let's remove the steel and aluminum tariffs, and so you start getting the good news flowing in. Then of course you start looking more carefully at the upper side of those distributions, and you'd want to be able to be flexible enough to have, in effect, every one of our meetings is live. And as Ms. Wilkins said in the opening remarks, markets seem to have settled on gradual, meaning we would only move every second meeting. To put it most bluntly, that's what I heard from the street. And we thought, well, we really don't want to reinforce that as a locked-in mechanical expectation. And so this is serving notice that it could be faster or it could be slower. And you watch the same data we watch, so it won't be that hard to kind of make some educated expectational guesses around that.
Bruce Campion-Smith, Toronto Star.
Good morning, thanks for this. Just to follow up on the question about the impact on households. I just wonder if you've done an assessment that as you move to perhaps a more neutral stance, 2.5 to 3.5, what will the impact of that be on perhaps households? You look at like whether, is there sort of a group of homeowners out there that are quite exposed from a debt standpoint, and that'll be a problem?
So this is in effect what we did in July, where we didn't do we didn't say this is what policy would do. I think we analyzed 100 basis points and 200. We analyzed 100 and 200 basis point moves, and we analyzed it across the full spectrum of credit debtors. So, you know, and of course, as Ms. Wilkins said a moment ago, those up in the upper tier, you know, experience the most difficulty. But within that, it's not everybody, because many have chosen the security of a 5-year mortgage. And so you know, we have to analyze not just in blocks, but think, well, how many folks are renewing at a point in time as we go through, say, the next 2 or 3 years. And some people, for instance, would be renewing at a lower rate than when they got their mortgage because of what's happened in between. So it's a very complex question. I know it's very easy to find the example of someone who's, you know, on the cusp of this, and we don't dismiss. You know, this is a difficult adjustment for people, no question about it. But it's you know, precisely why we've put in place a 2 percentage point stress test when getting a new mortgage, because everybody knew interest rates were lower than they would end up being. So it made perfect sense. We advocated it for quite a long time before it became practice, that people should be self-testing in this situation. But I think what's most of the discussion is focused on accessibility or affordability of housing, and how does the interest rate path normalization affect that. And I would just like everyone to bear in mind that, you know, a couple of years ago we were seeing rampant speculation in at least 2 major housing markets, which amount to a big percentage of Canada's housing market. And so housing prices that are rising at 20% per year or more are obviously affecting housing affordability, and by far more than 1/4 point, 1/2 point, 100 basis points in mortgage rates even come close to doing. And so as we go to a more normal environment where housing is, let's just say, more normal, where you don't hear about the bidding wars and prices aren't rising at 20%, et cetera, you don't hear about FOMO, fear of missing out, you know, I've got to get into the housing market now or I'll never get in. Those are the kinds of stories we were hearing in that phase. So the array of policies that have been put in place, both local, you know, as well as the B20 guidelines and the interest rate actions we've taken, that combination has calmed that down quite a lot, and therefore I think is actually contributing to housing affordability. Considering what might have been the case if none of that had occurred, hard to calculate, of course, but we can certainly imagine the house prices would be significantly above where they are today in at least a couple of key markets. And in exchange, you know, we've got some new rules, and we've got, you know, interest rates that are gently moving towards neutral. So anyway, that's more context around what it looks like. I get it that it can be difficult for some, but it's the reality is that the economy is running at its capacity, and it is no longer needing stimulus. And so it's our job to prevent the thing from overheating and creating inflation pressures down the road. And so we don't have any, so we're in good shape. But we're watching it very closely. Do you want to add anything to that, or?
Just one thing, because I think you raise a really good point, and this is important. We forget the counterfactuals are really hard to construct. At the same time, you can imagine that if house price growth and housing activity had continued on that what we thought was an unsustainable pace, that perhaps, and we didn't have those rules, perhaps people may have been able to purchase those houses, but being so highly indebted, so highly levered at a time when there might have been an even bigger possibility of a sharp house price decline, wouldn't have been very helpful for housing affordability for households either, because if you've just got a mortgage and you're highly indebted and you become underwater, that's not a very happy situation to be in either. And so to the extent that we see less evidence of speculation, and we see better quality of new mortgages, I think we're on more solid footing in terms of resilience of the economy, and that translates into resilience of people's incomes.
Steve Reuters.
Hello. I wanted to ask a little bit about the possible sort of headwinds for the Canadian economy. One of them is how much of a drag on the economy does the Bank of Canada see with the low prices of Canadian heavy crude? Is that I mean, you know, how do you see that developing, and how is that affecting growth?
So clearly, that is subtracting something from growth. As you know, the big gap between WCS and WTI is a function of a number of things, including transportation barriers. Some of the other things are a little bit more temporary, shutdowns, and we expect those to come back. And so nonetheless, we think, although the gap's especially wide right now, it should narrow a little bit over the coming quarters. On the other hand, Brent is a little bit higher than we had last July. Overall, when you look at the whole commodity space, it is weaker, and so it's shaving off a bit from Canadian growth relative to what we had in July, maybe 0.1 or so. And so it provides some of an offset to the good news that's coming from the USMCA.
And if I could follow up in the monetary policy announcement this morning, you said the U.S. economy is especially robust and is expected to moderate over the projection horizon. When do you see the sort of U.S. economy peaking? Do you see it already sort of coming down, you know, sort of slowing now, or is that coming up?
Yeah. So the big cycle in the U.S. growth and the strength now is coming from the fiscal stimulus, among other things, and so the pattern of growth that we have in our forecast is really a function of that, how we see the fiscal policy in the U.S. Continuing. So growth slows quite a lot leading out to 2020, with a little bit of slowing in 2019. So I believe growth is the strongest in 2018. Of course, we always stay true to what actually has been announced in terms of fiscal policy, whether it's in Canada or in any other country. And so it's possible that there's more fiscal stimulus coming from the U.S. or less, we don't know, and we would have to take that into account in future projections of the U.S. economy. But I talked a little bit about the fiscal as if that's the only thing, but it's hard to disentangle that from how the U.S. economy seems to be exhibiting some animal spirits that we'd been talking about for a while. I mean, at one point you get into this virtuous circle where businesses have good demand and they become more confident and they invest more, and we're seeing that virtuous cycle right now, and so that's what's really pushing up growth this year and into next.
Okay, and we have time for one more question from Yali Ndiaye from Market News.
Thank you. I just wanted to get back to the gradual, and in your speech in September, you said that the Governing Council had discussed not the word, but the approach, the gradual approach, and that was, and whether it was appropriate given that the economy had been running at potential for a year or so. And so this sounds like it's not because you want to avoid just an impression. It sounds like you wanted to say, while the approach itself might not be appropriate given the stage we are at, can you explain why now? It's because the explanation has changed.
Sure. So it is appropriate now, given the stage we're at, to have the flexibility that the governor talked about, to either go faster or to either go slower, and really pay close attention to the data, because we are at potential and we do have inflation at target. You remember in September there was an additional element that was there, which is the fact that the data we had seen so far on inflation was closer to the upper end of the target band. And we were very confident, as I said then in the staff analysis, that was temporary and that it would come down. But any good central banker is going to look at that data pretty carefully and assign a higher weight to it coming down when it actually happens. And so we've seen inflation go from 2.8% in August to 2.2% in September. That has validated the staff analysis.
Okay, and the other question was, I understand you reach your decisions by consensus and not a vote, but in your discussions, was there a point that was, for which it was harder to reach a consensus this time?
We were both in the room, so maybe I can say something, you can say something. Sure. You know, it's interesting because I think every time the discussions involve a bit of debate, not because we're not having a consensus, but because we're kicking the tires, and so we like to play devil's advocate. And this time, in fact, the things that I talked about in the opening statement were things that we discussed the most. How much of the uncertainty should we take off with respect to the USMCA? All of it? None of it? Should we wait? You know, and that was the point of discussion there. With respect to the housing market and the household imbalances, it was really a question of looking for the evidence we needed to make the statements that we think it's stabilizing and that we see the quality of debt is improving. And then, of course, with respect to gradual, I think I've said everything that there is to say on that. That just really reflects the conversation that we had in the room.
I don't think I have anything to add to that.
And in that note, we wrap up our news conference. Thank you very much for being here.